And here's Chapter 5, Variable Costing and Segment Reporting, Tools for Management. Learning Objective 1 is to explain how variable costing differs from absorption costing, and then to compute the unit product costs under each method. So variable costing is what we were working on in Chapter 3. In Chapter 3, we were talking about contribution margin, and our contribution margin equals sales minus variable cost. And then we would use contribution margin to cover our fixed costs. So there was an overall formula here of sales minus variable cost equals contribution margin, minus fixed costs equals net income. Absorption cost is traditional cost accounting as used by financial accountants. And here you can see the difference in a kind of a graphical approach. It's a little different from what the book does, but it should be helpful. Under variable costs, product costs would include only variable costs. So that would be direct materials and direct labor, because those are by definition variable. And they would also include variable manufacturing overhead. Period costs would be all fixed costs and also all selling and administrative costs. So you would take your sales price, you would subtract these variable costs right here to arrive at contribution margin, and then you would subtract your fixed costs in order to arrive at net income. Absorption cost includes fixed overhead into product costs. So product costs include not only direct materials, direct labor, and variable manufacturing overhead, but they also include fixed manufacturing overhead. And that's logical because fixed manufacturing overhead is part of the cost of making things. And therefore, it makes sense to include that in product costs. But from a variable costing perspective, it doesn't make sense to include fixed manufacturing overhead into product costs because these costs are fixed and they're difficult to trace to the products because by definition they're fixed. No matter how much or how little you produce, fixed manufacturing overhead is fixed, and therefore from a variable costing perspective it's going to be a period cost. But from an absorption costing perspective, because it's a manufacturing cost, it's going to be considered product costs. Selling and administrative costs, whether variable or fixed, are always going to be included as period costs. So here's a quick question. Which method produces the highest values for work in process and finished goods inventory? And the answer is absorption costing by definition, because absorption costing includes more cost. It includes these fixed manufacturing overhead costs, which we otherwise would exclude from product costs under variable costing. And again, you got to remember variable costing is useful for managerial accounting, but absorption costing is GAAP. And since it's GAAP, that's what we have to use for financial statements. So unit costs are going to be different under each technique. Let's say Harvey Company produces a single product with the following information. The number of products produced a year is 25,000. Variable cost or materials, labor, variable overhead is 10. Selling and administrative is 3. And fixed cost, manufacturing overhead is 150,000 fixed. And fixed selling and administrative is 100,000. So under absorption cost, your total cost would be materials, labor, and variable overhead, plus fixed overhead of 6, would give you a product cost per unit of $16 per unit. Variable cost would not include the fixed manufacturing overhead. It would only include the variable cost, and therefore unit cost would be only $10. Learning Objective 2, prepare income statements using both variable and absorption costing. Before I go into the actual income statements, let's just take a look at what we're doing here for a moment. And we're going to prepare income statements using both methods. Again, we have 4 types of costs. We have direct materials, direct labor, and manufacturing overhead, which we're splitting into 2 components, fixed and variable component. Under GAAP, variable overhead and fixed overhead both go into work in process. So you take your raw materials, put them into production, and then direct labor and overhead go into work in process. When the goods are completed and come off the assembly line, they go into finished goods, and that's still an asset as inventory. Finished goods, when it's sold, becomes cost of goods sold. And selling and administrative costs, whether fixed or variable, are always period expenses. Now, what we're going to do here is we're going to say that with absorption costing, which is GAAP, fixed overhead is included in work in process. But for purposes of variable costing, I'm going to switch it and I'm going to make it a period expense. And this way, my product costs are only variable expenses. And this makes it much easier to work with the numbers and to predict what's going to happen in the future. So now let's go to Weber Light Aircraft template. And the problem is that I have selling price of $100,000 per aircraft, direct materials $19,000 per aircraft, direct labor $5,000 per aircraft, and variable manufacturing overhead of $1,000 per aircraft. I also have fixed overhead, and I'm using the abbreviation MOH, manufacturing overhead, of $70,000 a month. And I have variable selling and administrative of $10,000 per aircraft, and fixed selling and administrative of $20,000. Again, I'm using, instead of saying selling and administrative expense, I'm using the abbreviation S&A. Now I also have some information here about how many units I produced and sold. So I started January with 0 units, and I made 1, and I sold 1. So therefore I had nothing at the end of January. I started the beginning of February with nothing. I made 2 and I sold 1, and then I had 1 left at the end of February. That's going to be important for later on. The beginning of March, I still had that 1 unit left over from the end of February. I made 4 and I sold 5, so I had nothing left at the end of March. So we'll need this information in a moment to do our calculations. Let's first figure out unit product cost under variable costing. Under variable costing, direct materials, we said, is $19,000. Direct labor is $5,000. And variable overhead is $1,000. So variable cost per unit, variable costing product cost, per unit, it would be $25,000. And it's very high because we're talking here about aircraft. So you can see that the aircraft are pretty expensive to make. It costs you $25,000 to make a single aircraft. So if we were to calculate cost of goods sold, if it's $25,000 a unit, and I sold 1 unit in January, then cost of goods sold in January would be $25,000. I also sold 1 unit in February, so cost of goods sold in February would also be $25,000. But March is a little different. I sold 5 units in March, and therefore total cost of goods sold in March would have been $125,000 under a variable costing regime. You remember, that's going to be as opposed to absorption costing later on. Now let's look at selling general administrator, or selling S&A. S&A, my variable S&A is $10,000, and I actually sold 1,000. So total variable would be $10,000 in January. It'd be $10,000 per aircraft times the 1 unit I sold in February, or $10,000 in February. And in March, it would be $10,000 times the 5 units that I sold in March, and therefore would be $50,000 in March. And selling administrative also has a fixed component. That would be in every month $20,000 right there. So therefore, my January S&A is $30,000. My February is also $30,000, and March selling and administrative expenses is $70,000. Now it's time for the pièce de résistance, a contribution margin format income statement, which is our favorite thing to do. So in January, I sold 1 unit for $100,000. So my sales in January would be $100,000. February, likewise, I sold 1 unit for $100,000. But in March, I sold 5 units for $100,000. So that would be sales. Now let's look at variable expenses. My variable cost of goods sold in January was $25,000, we said, and we calculated in February to be also $25,000, and in March to be $125,000. Variable selling and administrative expenses, because I want to keep them together, is $10,000 in January, $10,000 in March, and $10,000 in February, and $50,000 in March. So total variable expenses would be $35,000 in January, $35,000 in February, because I also sold 1 unit in February, and $175,000 in March. So my contribution margin in each month would be sales minus variable expenses, and it would come to $65,000 in January, $65,000 in February, because sales and expenses were the same in both months, but $325,000 in March. Now let's look at fixed expenses. My fixed overhead in January, fixed overhead is always the same, it's $70,000. So I'll fill that in here. And fixed selling and administrative is always going to be the same. It's $20,000. So it's going to be $20,000 in January, $20,000 in March, and $20,000 in February, and $20,000 in March. So total fixed expenses would be 70 plus 20 in each month, or $90,000. And net operating income would be contribution margin minus the fixed cost. It'd be a $25,000 loss in January. So you know what's going to happen in February, another $25,000 loss, and $235,000 in income in March. So this is already quite troubling because we can see that we're losing money in January and February. Now, let's just look at the contribution margin per aircraft sold. And again, what I'd suggest is that you pause the video before I go over these things. You might want to pause the video and try these things out yourself. Or what you could do is, as you're working through the template, just fill in these items as I fill them out and go over, make sure you know where every number is coming from. So the selling price per aircraft again is $100,000. It's not really the right link. Here we go. The variable production cost per aircraft is $25,000. And the variable selling and administrative costs per month is per aircraft is $10,000. So my total variable cost per unit is $35,000, and contribution margin per aircraft is going to be $65,000. So we can actually, if we don't want to do this whole big complicated income statement up here, we can actually do something much simpler down here. And that is take the number of aircraft sold, multiply it by the contribution margin per aircraft, and I get total contribution margin each month, $65,000 in January, $65,000 in February, and $325,000 in March. And then subtract from this total fixed expenses, which is $90,000 a month, to get net operating income of $25,000 in January, $25,000 in February, and $235,000 income in March. So that's variable costing, and variable costing is nice because it's very simple and straightforward. And again, the costing reflects the behavior of the cost. So we have the same fact pattern again, but now we're going to focus on absorption costing. So by absorption costing, the product costs include not only a variable cost, direct materials, direct labor, and variable overhead, but it's also going to include fixed costs, namely fixed overhead. And you could probably say fixed overhead one way or the other. Why does this make any difference to me? I'll show you why. Direct materials, again, is 19,000. Direct labor is 5,000, and variable overhead is 1,000. And we're dealing here with unit cost, right? So this is where things get very tricky. And you'll see, this is how we do things for financial accounting. Fixed overhead is 70,000, but that's total. I made one unit, so it costs all of that cost, that fixed cost went to one unit. So my fixed manufacturing overhead for January would be $95,000. Now for February, again, I've got 19 for materials, 5 for labor, and 1 for variable overhead. My fixed manufacturing overhead was 70,000, but that was needed to produce 2 units. So per unit, it's really $35,000 per unit. And therefore, the cost per unit would be $60,000. For March, my materials again is 19,000, labor is 5. Variable overhead is wrong. There we go. And fixed overhead was total 70,000, and I used that to produce 4 units. So my fixed overhead per unit is $17,500 per unit. So my March cost per unit was only $42,500. You see what's wrong here is that whether I produce a lot of units or a little, fixed cost doesn't change. So the more units I produce, the lower the fixed cost per unit and the lower the overall cost per unit. The units produced in January, February, and March are probably identical. And yet the cost is very, very different because of absorption costing and the weird thing that absorption costing does. So this is good enough for financial reporting. I happen to be, my area of expertise is financial reporting. This is good enough for us. But if you're a manager in a company and using this information to make decisions, this is very dangerous because you're going to present a report to your managers showing, hey, our cost per unit is half in March what it was in January. Aren't we doing a great job? And the only reason why it's so low is because you produce so many units. And you have to then explain that to everybody and say the reason why our cost per unit went down wasn't because I'm a genius, but rather it was because we made more units, we allocate fixed cost per unit, and the more you produce, the lower the fixed cost per unit. You can like play my video for them, okay? So this is very problematic, and it's GAAP, so it's what financial accountants do. But it's not what we're going to want to do in internal reporting because we can come up with something much more reliable and useful, and that would be the contribution margin format. So now let's look at absorption costing income statement. Sales is always the same. It's $100,000. Cost of goods sold, I just calculated. Well, I didn't. It's $95,000. In January because I only sold 1 unit. In February it's $60,000 because I only sold 1 unit. I should really do it this way. In March, however, wait, sales is wrong. It's 100,000 times the 5 units that I sold. So it'd be 500,000. Cost of goods sold would be 42,000 times the 5 units that I sold, or $212,500. But that's incorrect because not all, we made 4 of these units in March and 1 of these units was left over from February. So I got to do a little calculation here and I'm going to delete that. We had 1 unit we produced 1 unit in February, which we sold in March. That was the unit ending inventory. And back in February, it cost us $60,000 a piece to make these. In March, I made 4 units and I sold them all. And these units cost $42,000 because remember, the cost is different depending on what month you made the unit in. If you made it in February, the cost per unit is $60,000. If you made it in March, the cost per unit is only $42,500. But we sold 5 units. One of them was made in February and one of them is made in March. So we have to keep track of the fact that these are different. And you're probably going, oh wow, this is really complicated. I never want to do this. But this is what happens when you use absorption costing. So the cost of goods sold for March is actually going to be $230,000. And what you should notice here is that some cost is getting carried over from February. That's what's really happening, because a portion, this fixed cost was allocated to 2 units. We only sold 1, so 1 unit is still sitting in stock. It gets sold in February and now in March, we have this more expensive unit that costs us $60,000. Ironically, they both cost the same. So my gross margin or gross profit would be $5,000 in January, $40,000 in February, and $270,000 in March. My sales and administrative expenses would be the combination of fixed and variable. And I hope you don't mind, I'm going to do this in kind of an impromptu way. I sold 1 unit, so plus I have my, wait. I sold, you could do this with tables, is really more reliable. 1 unit for $10,000 plus the variable cost plus fixed selling and administrative is $30,000. For February, I also sold 1 unit and variable S&A is $10,000 plus fixed S&A is $20,000 or $30,000. For March, which is the same, it should be the same. For March, it's going to be a little different because I sold 5 units and the variable selling administrative is $10,000. Plus I had a fixed S&A of $20,000. So 5 times $10,000 is $50,000 plus $20,000 is going to be equal to $70,000. And that'll give me net operating income of $25,000 in January, $25,000 loss in January, $10,000 in income in February, and $200,000 in income in March. And let's compare it quickly to the contribution margin approach. Under the contribution margin approach that I just did, I had a $25,000 loss in January, it's just like this. In February, I had a $25,000 loss, not $10,000 in operating income. And in March, I had a $235,000 income. Now, the next topic, learning objective 3. It's a little complicated, a little technical, and this will kind of help you understand the difference between variable costing and absorption costing. And that's going to be to reconcile variable costing and absorption costing net income and explain the difference between the two. And the difference between the two, he said, is fixed manufacturing overhead, because fixed manufacturing overhead is expensed. It's not a product cost under variable costing. It's treated separately as a fixed cost. But under absorption costing, it's treated as a product cost. So we have to focus on here is the fixed manufacturing overhead that sits in ending inventory. So in January, there is no fixed manufacturing and overhead in ending inventory, but in February there is. If we go back to this problem again, we'll recall that we allocated $35,000 overall to fixed manufacturing overhead for the one product that was unsold over here. So here in my reconciliation, I'm going to insert $35,000. And that's because there was just 1 unit. And there were no units left. Those units were sold in March. So by the end of March, there were no units left in ending inventory. And there was no fixed manufacturing overhead in beginning inventory in January or March. January, February rather. I keep mixing up the months. But in March, this 35,000, this 1 unit was sold. If you remember back from here. We had this 1 unit in ending inventory at the end of February, and it was sold in March, because in March I made 4 units, but I sold 5. One of those units was the units that was in beginning inventory that had been left over from the end of March. And therefore there was nothing left to the end of March. So this one unit here had this fixed manufacturing overhead, which was causing the difference between the absorption costing and the variable costing. And so I have to account for that difference. So if I go ending inventory minus the fixed manufacturing overhead in beginning inventory, then I would have a $35,000 difference in January and February. In February, and then it would reverse itself in March, like so. So my variable cost net operating income is shown here. And then if I add or subtract this figure, I'm going to get my absorption costing income statement. And you can check this against the numbers that I had for absorption costing. It was $25,000 loss, if you remember, on absorption costing in January, $10,000 in net operating income in February, and $200,000 in net operating income in March. And let me just give you, in case you're turned off of variable costing now, and I've been talking about variable costing in the last 2 chapters quite enthusiastically because I want you to be a believer in it, just like I'm a believer in it. So let me give you another advertisement for why variable costing is so great. We had sales of 100,000, right? And contribution margin per unit of 65,000 and contribution margin ratio of 65%, and let's say total fixed expenses are $90,000. So if we had target profit, let's just take March for a moment and say we wanted to make $235,000, and my fixed expenses I know to be $90,000. And let me just point out that fixed expenses is what's fixed expenses in this problem. So my contribution margin ratio, we said, is 65%, and the dollar sales to attain your target profit would be the target profit of $235 plus $90,000 divided by the contribution margin ratio, and you would get $500,000 sales in order to attain your target profit under variable costing. So does this work? Let's see. That was our sales, if you remember. Under variable costing, that was our sales in March. So what this kind of does is it just checks our work, and it says, okay, if you need $200,000 in income, and you have $90,000 in fixed expenses, which is what we have, and your contribution margin ratio is 65%, then in order to achieve this, you should have $5,000 in sales, and that's what you have. And the really nice thing about variable costing is it allows you to do these quick calculations to see how much you need to sell in order to break even. This is a very important thing to note here from the textbook PowerPoint slides. Because absorption costing assigns fixed manufacturing overhead costs to units produced, and here it says $6 per unit for Harvey Company. We saw a different example. It gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it is not. The result can be inappropriate pricing decisions and product discontinuation decisions. In other words, this is so dangerous that this could cause you to make bad decisions that will lose money. Learning objective 4, prepare a segmented income statement that differentiates traceable fixed costs from common fixed costs and use it to make decisions. And this is really where the wonders of variable costs help you make decisions. This is why variable cost is so great. Consider that a company isn't just a company, but it's made up of a lot of little parts. So you have what's called segments. And a segment is any piece of the company that you would use to collect information. So if you have a retail chain, every store could be a segment. You could break the country down into sales territories. You could have different service centers, all sorts of different things. But what you would usually try to do is when you're running a business, you try to break it down into smaller pieces that are more manageable. So when we're looking at segmented income statements, we're going to try to look at a contribution format income statement because it's going to separate your fixed costs from your variable costs and enable you to calculate your contribution margin. And we really want to focus here on traceable fixed costs, because traceable fixed costs are those costs that can be separated for that segment. In other words, a traceable fixed cost is a fixed cost that would go away if the segment went away. A common fixed cost would be a fixed cost that supports multiple segments. In other words, this fixed cost is related to 2 or 3 or 5 segments, and if one segment goes away, the common fixed cost is going to still be there. For example, suppose you have a building with 2 divisions in it. Then all the costs of running that building are probably going to be common fixed costs, because if one segment left the building, you would still have all these costs. The costs would still be there. At least the fixed costs would still be there. So we have a difference between what's called a traceable fixed cost. If the segment went away, the traceable fixed cost also goes away, as opposed to a common fixed cost, which does not go away because it's also attached to other segments. And then we have what's called segment margin, and this is so key. It's such a great thing. Segment contribution margin minus traceable fixed costs would give you the term segment margin. And you could use segment margin as a simple rule of thumb that if segment margin is positive, then this division, as long as it's around, is contributing to cover your common fixed costs, and it makes your company more profitable. When you see segment margin that's negative, that would tell you that this division is losing money, and if you got rid of it, you would make more. So let's look at the example in the book again, Profit Max Inc. Here's an income statement for Profit Max Inc. You could see here sales minus variable cost of goods sold and other variable expenses, probably selling expenses, equals total variable expenses, giving you a contribution margin of $270,000, minus fixed expenses equals net operating income, $13,500. So you may look at this and be like, what's the big deal? I'm going to explain to you how you can break this down and start to understand where the money is and where it isn't within this company. So we have this whole big company here. Profit Max has 2 divisions, Business Products Division and Consumer Products Division. Consumer Products Division sells 2 product lines, computer games and clip art. And computer games is sold through 2 sales channels, online sales and retail stores. So it's not just 2 divisions. There's 2 divisions, and one division has 2 product lines, and one of the product lines has 2 sales channels. And this is a little complicated. But what's even more complicated is the fixed expenses. The Business Product Division has its own fixed expenses of $90,000. Clip art and computer games have traceable fixed costs. Those are down here. Traceable fixed costs of $30,000 and $40,000. And then they have a common product fixed cost of $11,000. So for the Consumer Products Division overall, fixed costs are $81,000, of which $30,000 is traceable to clip art, $40,000 is traceable to computer games, and $11,000 is common. So $90,000 of overall fixed costs are traceable to business products, $81,000 are traceable to consumer products. Then there's common fixed expenses for the whole organization on top of this of $85,500. And then we get total fixed expenses of $256,500. And this provides us with key insights so we have an understanding. For example, if I eliminated computer games, then this traceable fixed cost would go away. But the common product fixed cost would not, product line fixed costs would not go away, only computer games. If I eliminated this whole division, then all of 81 consumer products division, 81,000 would completely go away, including the common product cost for clip art and product lines, common product line cost. But the common fixed expenses of 85,500 would remain, and business products division costs of 90,000 would also remain. Now, Exhibit 5-8 has all of this in a lovely little chart. And let's work on this one piece at a time. So we have here, first of all, profit max overall and its two divisions, business products division and consumer products division. So we already went through the income statement of profit max as a whole. And I should just note here, there was a little typo in this exhibit. It's also in the book, I think. It's in my copy of the book, at least. It says 85,000. It should say 85,500. It's just a little typo. So if we break this down between business products division and consumer products division, we'll see that of this traceable fixed expenses, and one other thing I just want to point out here, and I'd just like you to notice that total company fixed expenses have been broken down into two pieces. Traceable of 171,000 and common of 85,500. So the traceable expenses of this 90,000 goes to business products and 81,000 is going to consumer products. So I'm able to figure out divisional segment margin of each one. And you can see here that each one contributes some segment margin to cover the common fixed expenses of 85,500. Net operating income is positive, which is a good sign. Let's break down consumer products division into more little pieces. If you remember, we had 81,000 in traceable fixed expenses. 70,000 is traceable to the product lines, but 11,000 of that is not. So this 81,000 up here is split up into two pieces, the traceable portion and the common portion, traceable being 70,000 and common being only 11,000. Now, how is this traceable? It's traceable to the individual product lines. 30,000 of it is traceable to clip art, and 40,000 is traceable to computer games. And remember again what traceable means. Traceable means that if I get rid of clip art, then that $30,000 of traceable fixed expenses will also go away. So when I figured this out, I discover, and I hope you don't mind that I'm not doing the calculation because we've seen this calculation many times, and you should be familiar with how this calculation is done already. Sales minus variable expenses. There's two kinds of variable expenses here. Cost of goods sold and other variable equals contribution margin, minus my fixed expenses equals overall net income. But I'm breaking my fixed expenses into two pieces. So again, I have my clip art and my computer games. Now let's go down a step further, dig down further into computer games. And we have two sales channels for computer games. Computer games had 40,000 in traceable fixed expenses, of which 25,000 is traceable to the different sales channels, 15,000 to online and 10,000 to retail. That's 25,000. And the remaining 15,000 is common, meaning that this, let's say it's a machine, it's that we have to use for online and retail. So even if I got rid of online or I got rid of retail, I would still have this machine and I would still have to pay this 15,000. So we arrive at an interesting thing here, and that is that my sales channel segment margin for retail stores is negative. And if you remember, the first thing I told you way back when, I said segments with positive segment margin help cover common fixed costs. What that means is that segments that don't have positive segment margin don't help to cover common fixed costs. And that is the case here with retail stores. So this is going to create an interesting opportunity for us because retail stores has a negative segment margin. Let's come back to that in a few minutes. But for now, let's focus on testing this to see what works and what doesn't work, to get a better understanding of what's really traceable and what's common. A little bit more about traceable and common. Traceable fixed costs arise because a particular segment exists. And if the segment disappeared, then the traceable fixed costs would go away. So if you didn't have a computer division, then you wouldn't need a computer division manager, and this fixed cost would go away. He wouldn't like that, obviously. No one wants to be a fixed cost. No one wants to be overhead. I take great pride. I am a profit center. I teach students, and that brings in revenue. Although I guess I'm a fixed cost. That's a little. I guess I am a fixed cost. Anyway, and I'm traceable to the business school. Identifying common fixed costs. Common fixed costs exist because even if you got rid of a division, these common fixed costs would still be there. If there's no computer division, we would still have a company president and we would still need to pay them. So a traceable fixed cost of one segment could in fact be a common fixed cost of another segment. So let's say you have aircraft, and the aircraft has 3 classes that you keep track of: first class, business class, and economy class. And you have a landing fee. So this landing fee is a common cost with respect to the flight, but it's traceable to the flight itself. And what you don't want to do is you don't want to allocate common costs to segments. That's really where you get into danger, and that's where you start making mistakes. So with all this information, what you can do is you can calculate break-even point for a segment. But when you do that, you want to focus on traceable fixed cost, because that's the fixed cost that's related to the segment, and common fixed costs can't be changed. And actually, before I get into break-even costs, let's rewind a little bit. What would we do? Here you can see retail stores is negative segment margin. So negative segment margin means that if I get rid of retail stores, then my overall profit would increase. It's because we always want to have a net positive segment margin, because that means that some money is going to common fixed costs. Let's say retail store is closed. Then we happen to know that online sales would increase 10%. So now what would happen if we closed the retail stores? For one thing, we would save this $3,000 in segment margin. So over here, I'd have the avoidance of the loss in retail stores. And that would be $3,000 saved. But I'd also have an increase in online sales. So I could do a whole new income statement for online sales. But the really nice thing about contribution margin is with contribution margin, I don't have to do that. Rather, what I could do is I could just focus on contribution margin. If my contribution margin from online sales is $63,000, and that would increase by 10%. So 63,000 times 10% would be an increase in overall income of $6,300, and fixed costs would stay the same. So my overall expected increase in NOI as a result of closing down retail stores would be $9,300. And what that would tell you is, you do this calculation, and you know that the traceable fixed cost for retail stores is going to go away, but the common fixed expenses not traceable is going to remain. And even taking that into account, income would be increase $93,000. So what we've done here is we've constructed the contribution margin and segment margin for each of these divisions. And now let's see what would happen if, based on these fixed expenses in the different divisions, what the break-even would be for each division, and then what would happen if we broke even? What if we reach those amounts of sales? So let's look at the company overall for a moment. The company overall has traceable fixed costs given up here, and these are all coming from here, of $171,000. It's also got common fixed expenses of $85,500. You have to be careful of that little typo. The contribution margin ratio would be equal to the overall contribution margin, in this case 270, divided by total sales, in this case 500, or 54%. So break-even sales in dollars divided by contribution margin, if you remember, and that's the formula is given to you up above, would be traceable fixed expenses plus the common fixed expenses divided by the contribution margin ratio, or $475,000. Now compute dollar sales for business products division to break even. All right, let's look at business products division for a moment. For business product division, I'm going to have traceable fixed expenses of $90,000. And the contribution margin ratio, overall contribution margin in this case is 150. I have to type it in because that's not really part of the spreadsheet, it's an image. Total sales is 300,000. So my contribution margin ratio would be 50%, and break-even sales in dollars would be 90,000 divided by 50%, or $180,000. So I would need to sell $180,000 in the business products division in order to break even. What would I need to make in the consumer products division? Traceable fixed expenses is 81,000. The CM ratio, overall CM in consumer products is 120, and total sales in that division is 200,000. So the contribution margin ratio in that division happens to be 60%. So my break-even sales for consumer products would be 81,000. That's traceable fixed expenses divided by 60%, or 135,000. So what would happen if they both broke even? So business products division would have break-even sales of 180,000. Consumer products division would have break-even sales of 135,000. So that would be a total of 315,000. And I kind of have to, because I could figure out variable expenses in two ways. I'm going to kind of back through it. My contribution margin in this case for business products division would be 180,000 times 50%, or 90,000, and for consumer products division would be 135,000 times 60% would be my contribution margin of 81,000. And then my variable expenses would be the difference between these. So I'm doing this a little backwards just to save time. Otherwise, I could just look them up and get the same numbers, basically. And what's traceable fixed expenses here? For business products, it's 90. For consumer products, it's 80. So my segment margin would be 0. This is great. And for each segment, business products would be 0. Consumer products would be 0. There's just one thing, and that's the common fixed expenses way up when. So if you remember, we had common fixed expenses here of 85,500, or shown right here. And I still have that to cover. My common fixed expenses of 85,500 would still need to be covered, and therefore I would lose 85,500. So what this is saying is that even though each division needs to cover its traceable fixed cost, that's not enough, because you still need to cover your common costs. And if you only cover the traceable fixed costs and not the common fixed cost, then you're going to lose money. So you got to be careful when you apply this to make sure that you've got your common fixed expenses in there. When you work on these analyses, you have to keep in mind that you want to include all of the costs that are part of the company's value chain. So that includes things like R&D, product design, manufacturing, marketing, distribution, and customer service. That being the value chain. In other words, you design a product, or rather you have research that is the foundation for the product design. You manufacture the product. That's what we always think of. We think of marketing and distribution, but there's also customer service. And all of these costs should be included in your analyses. And it's easy to mess up an analysis by not properly tracing the costs to the individual segments or using a bad allocation base. So common costs shouldn't be arbitrarily allocated to the segments. If something is a common cost, then it should be treated as a common cost. Misallocating costs is going to make profitable segments look unprofitable, or unprofitable segments look profitable. It's going to hold people accountable for doing things that they have no control over, or not holding them accountable for things that they do have control over. And therefore, you want to be very careful about how you apply these costs, and, or I should say, how you allocate the costs to individual segments. So remember that absorption costing is GAAP. It's also IFRS, International Financial Reporting Standards. And financial statements are going to be based on absorption costing. And many companies will use absorption costing in their internal financial statements too, meaning that fixed manufacturing overhead will be treated like a variable cost even though it's fixed. And so it would be a lot of work for a company to maintain both systems, but the benefits of maintaining both systems is being able to calculate contribution margin easily and to be able to use contribution margin in your calculations. So fixed manufacturing overhead, it's extremely important to apply it to the right place. And again, in absorption costing, it's going to be a product cost. But in a variable costing environment, your fixed manufacturing costs are going to be treated as a fixed cost, and it's not going to be included in contribution margin.